معرفة.
Bismillahir-Rahmanir-Rahim. Let us discuss about corporate financing. So these structures are, for example, Murabaha based, Musharaka based, Ijara based, that is lease, Salam based, and Istisna based. So these are Murabaha based, Musharaka based, Ijara based, Salam based, and Istisna based. Let us start with Murabaha. For example, if a corporate needs to buy certain vehicles, so how the structure is provided by the Islamic Bank. And this is the corporate, and the corporate is requiring to buy certain vehicles for its use. Now, if we use the Murabaha structure, so this is the corporate coming and approaching the Islamic Bank. So there is a promise to purchase. So the corporate in a unilateral promise is mentioning that if the Islamic Bank purchases certain goods as mentioned in the promise to purchase, then the corporate in turn would buy those goods. So after that first step happens, the Islamic Bank goes and purchases the identified assets or goods from a dealer. The Islamic Bank pays the purchase price, and after purchasing the goods, the Islamic Bank would add its profit margin, okay, and sell those goods, okay, through a Murabaha to the corporate, and the corporate in turn would pay the deferred payment price during the term of the Murabaha. So this is in brief how a Murabaha would work. Some of the important points, of course, as we have discussed in Murabaha, which should also be there in this Murabaha, is the goods should be identified, the risk should be properly transferred to the Islamic Bank before the Islamic Bank could sell it to the corporate. The Islamic Bank should first purchase the assets, take the assets in its possession before the Islamic Bank could sell those assets to the corporate. And then, of course, the Islamic Bank, because this is a Murabaha, should clearly mention to the customer the cost price of the goods and the profit which the Islamic Bank is charging to the corporate. And then there is a deferred payment which is done by the corporate to the Islamic Bank over an agreed period of time. So this is in brief how the corporate financing is done for actual goods if they are required by a corporate using a Murabaha structure. Let us take another example of using Ijara. So for example, if this corporate needs to buy certain real estate assets for its employees, so for example, if the corporate wants to provide housing facility to its employees and the corporate wants the Islamic Bank to finance the purchase of those houses, so the Islamic Bank could use the structure of an Ijara, which is a lease. So for example, the corporate is approaching the Islamic Bank, so there is a promise to lease. The corporate is mentioning in the promise to lease that if the bank purchases those identified assets, then the corporate would lease them in return from the Islamic Bank. So there's a promise to lease, and then the Islamic Bank would go and purchase the identified assets. So the Islamic Bank makes the payment, purchases the identified assets. The transfer of ownership is done between the seller and the Islamic Bank. The assets are transferred to the Islamic Bank. Now the Islamic Bank enters into a lease contract with the corporate. So these assets are leased to the corporate, and then the assets are delivered to the corporate, and the corporate pays regular rental payments to the Islamic Bank. The Islamic Bank builds the profit in the rentals, the regular rentals which the corporate pays, and after the term of the financing is done, for example, if this financing is done for a period of 5 years, then after 5 years then the ownership of these assets is transferred to the corporate either through a sale and purchase agreement or through a gift contract. So this is in brief how a corporate financing is done for any assets using the Ijara concept. Here let us understand how Musharaka is used. Musharaka meaning to say a partnership. So this is an Islamic bank, this is the corporate, and the corporate requires certain capital, okay, to invest in a project. So the Islamic bank provides that capital to the corporate, okay, to be invested in a project, and the corporate would use its expertise, okay, and the corporate would also contribute its portion in the project. So meaning to say, in a Musharaka, the corporate and the Islamic bank both are partners in this project. So whatever profit is realized, that profit is shared between the partner and the corporate based on the agreed profit sharing ratio. Now the one important point in Musharaka is that the profit sharing ratio can be agreed between both the parties irrespective of their investment. Meaning to say, for example, if the investment in this project from the Islamic bank was 80%, so just for an example, if this project was valued at $100 million and $80 million, for example, are given by the Islamic bank and $20 million are given by the corporate, but they both agree in the Musharaka agreement that the profit would be shared in the ratio of 50:50. So if there's a profit of $10 million, $5 million will go to the Islamic bank and $5 million will go to the corporate. But in case of a loss of $10 million, $8 million would be borne by the bank and $2 million will be borne by the corporate. Meaning to say that the loss will be in proportion of the investment, but the profit could be based on the agreement of the parties. So this is in brief how a Musharaka financing would be done to a corporate.